My name is Veit Henich. I'm the Vice Dean Faculty Director of the ESG Initiative at the Wharton School, also the Deloitte & Touche Professor of Management, on the faculty for 27 years with a background looking at political and social risk management and trying to look at how stakeholders, communities, non-governmental organizations, political actors affect the value of a project, the value of a firm, the value of an investment over that time. In recent years, the scope of that demand from the community, from the government, from the stakeholders has expanded. And it's touched on a broader array of areas that have coalesced into this topic of ESG. On the one hand, this is innovative. It was a new program that was launched in the summer of 2022. At another, it's really consistent with the founding principles of the mission of the Wharton School, in the words of Joseph Wharton, harnessing the power of business to address some of society's greatest problems. So I want to give you a little bit of an outline of what we do, who we are, how we're doing it, and then leave some time at the end for questions. So at some level, there's enormous demand from a range of our stakeholders to address these questions. From our current students, I'll talk about that, from our alumni, from our executive audience, from the policymaking and leadership of the firms that we work with. They want to understand how the climate transition is going to affect the value of their projects, their investment decisions, their hiring decisions. Some of the current macroeconomic forecasts suggest we're on track, if we continue towards a 3-degree or 3.5-degree warming scenario, for $10 trillion of global losses to GDP. And yet, none of the current valuations of stocks, bonds, real estate correctly reflect that potential loss. So sometime between now and then, we're either going to discover some technology that no one's figured out yet that'll help us avoid that warming scenario, or all those asset prices have to correct. That seems like a problem for Wharton to get into. We could talk about similar scale problems on social justice, dealing with populism, dealing with governance and ethics disputes. But those are the range of topics we're looking at that a lot of current financial valuation models leave out. A lot of current strategies leave out. To give you a sense of the types of things we fund, this is a word cloud from the research projects that our faculty have submitted that we've funded at the ESG Initiative. And you'll see some words standing out that you're probably not surprised about. Firm, market, invest, cost. Yes, we're looking at climate, we're looking at social justice issues, we're looking at ethics and corruption, but we're doing them through the lens of the Wharton School, through the lens of business case. Is there a business case to do this? What are the risks? What are the opportunities? We're trying to train some of our current students, our executives, our alumni, and some of our outreach programs to follow the footsteps of some prominent Wharton alum. I just had the pleasure last Thursday in DC of hosting a dinner with Wayne Silby and John Guffey. They were graduates of Wharton in 1970, at a time where there were 4 women in the Wharton program, and there wasn't anything like the ESG Initiative or anything to do at all with social impact and the impact that their investments have on social outcomes. But while they were Wharton students, in 1970, the same year that Milton Friedman wrote that the purpose of the corporation was to maximize profits, they tried to form or came up with the idea of forming a different kind of investment company. They got side-railed a little bit by John's enrollment in the war in Vietnam in the draft and Wayne's law school time. But in 1976, they founded Calvert Social Impact. And they became one of the largest asset managers that had a social mission at the heart of the foundation of the organization. We just hosted Michael Baum, a $28 billion exit from his entrepreneurial venture, and he's now formed the YOPE Foundation, Youth and Hope, to fund new student ventures that could scale to address the world's greatest problems. Abriel Rosenthal at Tower Brook Management, a partner there who leads their ESG practices. Joe Lipscomb at Arborview Capital, whose foundation has looked at the ways that the climate transition is creating new business opportunities for early stage venture capital. Bobby Turner from Turner Impact Management in Los Angeles, a longstanding benefactor of ours, who's found ways to make profitable investments in low and middle income real estate across the country by addressing some of the social challenges that those community members usually face and earning 25 to 30% ROI for his investors at the same time. And then 2 of our most recent alumni, Madeline Evans, who heads Impact for Generation Impact, based in London, working with Al Gore and David Blood, and Emma Park, who previously worked with Joe at Arborview and now is at Goldman Sachs. These were all alum who in different decades, without the support that we now provide, found a path to turn their Wharton training into investment careers that address some of these great social challenges. We want to make it easier for the students that follow them. We do that by combining 5 different operating units, focused on political risk, where I have a background, but also on the challenge of climate, the challenge of governance and ethics, the challenge of ESG. All of these operating units, supported by a staff of 13 staff members who provide unified marketing and communications, administrative, financial, student programming support to each of these faculty-led operating units. We fund over $3 million of research. We have 53 faculty at the Wharton School who are doing research in this. That's 1 in 5 faculty at the Wharton School are now doing this. Disproportionately the younger faculty, disproportionately, but across all 10 departments. And we also have 17 research fellows and almost 40 doctoral students engaged. Everything that Wharton does, we are trying to enable and enhance on the ESG side. It starts with research, academically rigorous research that's practically relevant, that looks at the valuation of climate, the valuation of social justice, the valuation of corruption. Why is there a gap between some of the economic models, implications of what these things will cause, and the current asset valuation? We also bring that into the classroom. Over 30 courses now, assembled into majors and concentrations that the MBAs and undergraduates can take, assembled into executive education programs, such as the one that Annie mentioned, that we're reaching a wide and diverse audience globally. And we hope to soon form a partnership with the United Nations Principles for Responsible Investing to enhance the scale and scope of that. And our research is shaping policy and practice. Firms come to us in the same way they come to Eric with data and challenges and questions about how do we do this? We think ESG matters for municipal bond finance, but we don't know how. Morgan Stanley's pricing model now for municipal finance includes research done at the Wharton School, as does their real estate pricing model. There's also a publication that highlights that collaborative research. So we're shaping policy and practice through our research. On the research side, one of the challenges is we don't have good data on climate, on stakeholder concerns, on stakeholder actions, on what firms are saying. It's not part of the audited financial disclosure. Historically, it hasn't been part of Wharton Research Data Services. So we've amassed 26 new data sets that are available to Wharton faculty to do research on these topics. And that's creating enormous leverage on new research questions and new approaches beyond what are traditionally done in the academic field. This is an unparalleled assembly of data that would cost millions of dollars to compile in the private sector. Almost every single one of these data providers gives us the data for free because they want Wharton faculty and research to analyze the veracity, the integrity of the data, and whether it's really fit for purpose. We bring it to our students. In the first year of launch, the ESG major was the 6th most popular major among Wharton MBAs. It was on track to be number 4 this year as of October. We'll see where we fall out at the end of the year, but we're anticipating still being in the top 5 and hopefully meeting that top 4. Over 400 students across Penn apply to be in one of 10 of our co-curricular programs, where they get out of the classroom training in what it takes to be an impact investor, how to assemble a portfolio that encompasses climate issues, how to do an ESG consulting project if you get hired by one of the big consulting companies. They're working with Wharton alum as mentors, and they're going out and getting practical real-world experience, taking the classroom experience out into the field. We have a wide range of industry mentors working with our students, and we don't limit our training to Wharton students alone. Over 60 different universities participate in some of our open programs in which they're getting elements of the Wharton training program through online learning platforms and then coming to Wharton for championships, which are actually going to be held just in 2 weeks' time on April 2nd and 3rd here on campus, 4th and 5th on campus. Over 600 students participating in these programs from some of the top universities in the world. In terms of industry demand, $2.8 million of sponsored research projects where people like Morgan Stanley come to us and say they have a problem, we have some data, we have some ideas, but we want to work with you to advance that problem. We understand that you're not consultants. We understand that you're going to publish the academic research in peer-reviewed papers, but that's what we want. We want objective third-party research, and we think that can give us commercial advantage as well by combining it with proprietary data and tools that we have. Over 250,000 website visits, 15,000 newsletter subscribers, people who trust Wharton's statements and findings on what is now a politically contentious topic. Now, I'd be remiss if I didn't acknowledge that it is a politically contentious topic now.
I was going to say.
So, to preempt some of the questions, but I do want to leave some time for questions. Look, this is just information, right? This is information about climate. This is information about firms' actions engaging with the political environment, with community stakeholders, with NGOs. Why would we restrict asset managers' ability to analyze information to see if it's material, right? This is about the freedom to analyze information. That is not political, it is not ideological. This is financial information. 100 years ago, we used much less information to assess the value of companies. This is new information. We should be assessing where, when, and how ESG factors are valuable. Industry wants this. Industry is coming to us with these questions. Our students want this. They're signing up for the classes. They're taking the major. There are policy debates about which information is material and which information isn't. Shouldn't Wharton be contributing to the research that determines what the information is that is required to be disclosed? And according to a compendium of 10 different law firms who compiled a study, it is not only consistent with fiduciary duty to undertake such analysis of such information, it is a fiduciary requirement. We emphasize that we're analyzing the business case. We're not coming to this with preconceived answers about where, when, and how ESG factors are material. We're doing the research to figure it out, to inform good policy, to inform good practice, to inform good investment. Those are our approaches to the political headwinds. Happy in the last 3 minutes to take any additional questions you have. There were a lot of chuckles on the political headwinds, so happy to address that. But if you're interested also, take a look, sign up for our newsletter, get involved at esg.wharton.upenn. Please.
Professor Hanush, I'm Warren Wang from the Wharton Energy Network. I just want to say thanks for speaking with our members previously. Nick Renard helped organize a speaking event. Hugely consequential, reputational, operational, existential. But, as you pointed out, there's controversy. People see it as environmental wokeism in some ways, right? At its root, the ESG initiative came, I believe, as part of it stemmed from the Risk Center. Mm-hmm. And is there any thought to maybe bring that factor back in? Because perhaps if you tie together, the risk and the ESG together, and maybe raise that consciousness of, I need to consider this because I'm from Southern California, where the Palisades, a community that's existed for many decades, people lived there for 50 years, never had any issues, and then suddenly it just went up in smoke. Yeah. How that's a risk issue, it's an environmental issue, and how can we combine it in a way so that it's raised in people's consciousness so that people don't see ESG purely from this political negative terms.
Yeah,
see it as a real issue.
I apologize if I didn't make that clear enough. That's exactly the approach we take, or at least half of it. The Risk Center became the Climate Center because an increasing amount of the tail risks that Howard Kunreuther, who was a longtime leader of that center, were looking at were climate-related, extreme weather, hurricanes, fires, as you suggest. It was renamed the Climate Center and is an integral part of our initiative. The largest percentage of majors in the ESG are focused on business, environment, energy, and sustainability, which came out of the work there. The reason ESG factors have impact on value is either because they introduce risks to the value of ongoing operations or assets, or opportunities. And the reason we don't overly emphasize risk is we think some of the opportunities might be greater. We think some of the next unicorns, some of the next trillion-dollar valuation companies might be in the area of green steel, green cement, the technologies, the power of the energy transition. We don't want to overly focus on downside risk mitigation. We want to look at both risk and opportunities. But whether it's climate, whether it's political risk, whether it's ethics, whether it's economic opportunity, risk and opportunity are at the heart of everything we do. That's why there's a business case to do this, and everything we're doing is assessing the business case for these factors, very much consistent with the work of Howard and Paul Kleindorfer earlier at the Risk Center. So very much following in their footsteps, and worked closely with both of them for many years. I don't know if we have time for one more question. I see the clock ticking down. Any others? All right, I'll finish there. Thanks very much.